The Bank of Canada is set to cut interest rates yet again on September 4th, but will it be enough to revitalize the real estate market? With the number of active listings higher than we've seen them in years and sales not keeping pace, will a measly quarter-point interest rate cut actually be enough to stoke the market? Reports on inflation have recently showed that it's dropped to 2.5%, which has experts predicting we'll see another 3 interest rate cuts by the end of the year. And this would effectively bring the overnight lending rate down from 4.5 to 3.75. But something to keep in mind is that when the Bank of Canada starts decreasing interest rates, that means that the economy isn't looking great because they're doing this in order to try and give it a boost. So while a reduction of interest rates is typically correlated with an increase in prices, they don't always happen at the exact same time. Typically, it will take somewhere between 12 to 18 months to actually see the impacts of interest rates, whether they rise or fall. And the reason being is that it doesn't impact everybody. Those with a variable rate mortgage at this point in time, yes, it will have an impact on them. Those that are tied into a fixed rate, no, it's not going to have an immediate impact. However, those that are currently looking to buy or thinking about making a move, it could potentially make an impact for them. However, you have to remember that at this point in time, fixed interest rates are still about 3/4 to a full percent lower than variable rates. And that means even with a quarter-point decrease, nobody is actually getting more buying power because of the fact that they can still get a fixed rate mortgage for way cheaper. Now conversely, the major factor that could make all the difference here is something that's not necessarily easy to measure, and that is the market sentiment. Many people have been sitting on the sidelines waiting for a better time to buy, waiting until it looked like interest rates were going to start to come down, and now that they have, the Bank of Canada, inflation, everything else has signaled that they're going to continue until the end of the year and into next year to further decline, so people want to get ahead of the curve. Because if you're waiting for rates to drop significantly and assuming that prices will also drop alongside that, I hate to say it, but you're probably going to miss the boat. Now, that's not to say that you need to rush into buying a property or anything else. However, I do think we have a limited window of time before things turn around again. And in general, the real estate market comes down very slowly, but goes up very quickly. So what exactly is going to happen as we head into September, into the fall market, and then after that for the rest of the year? Well, in my opinion, it's going to be a battle of 2 factors. One of those being interest rates coming down and buyers coming back to the market, and conversely, we're going to have the number of listings. Or more simply, the 2 main driving factors of the market, supply and demand. I do believe without a doubt, buyer demand is going to continue to rise as we head into the fall market and interest rates continue to come down. However, we're also going to see a number of new listings come to the market as well. So it really just depends on if the buyer demand outpaces the sellers, or if there's just going to be too many new listings coming to the market, giving buyers more options and pushing prices downward. In all honesty, at this point in time, it's a little bit of a toss-up. And then on top of that, you're going to have the argument that has been made for the past number of years about this mortgage renewal cliff that we've yet to see, but it seems like they just keep pushing it another 6 months, another 6 months, another 6 months. However, what people often forget as well is that anybody who qualified years ago had to do so under the stress test. Now, dependent on what year these individuals got their mortgages, the number is going to be slightly different, however, still very close. But the current stress test is set at the higher between 5.25% or your contract rate plus 2%. That means at bare minimum, anyone who got a mortgage had to qualify at 5.25%. And right now we're seeing fixed rates anywhere from the mid to low 4s up to around 5%. And while yes, the cost of everything else has gone up as well, people have the ability to make lifestyle changes as much as they don't want to. Canadians are some of the best, if not the best in the world at paying their mortgages. Mortgage arrears are still at extremely low rates, and people will do whatever it takes in order to keep their house. That may mean not going on vacation for the year, or selling off that overpriced car, or not going out for dinner on a weekly basis. But most people have more wiggle room than they think. They just don't want to give up their current lifestyle. And the reason why the stress test was implemented in the first place was exactly this, so that people would be protected from over leveraging themselves to some extent if rates were to go up in the future. Now, are there going to be people in tough financial situations that are going to have to make difficult decisions? Yes, without a doubt, but the large majority, I think, are not in that bad of a position, even if their lifestyle needs to change. So what exactly is going to be happening in the real estate market over the next few months here is still up in the air, but I'd love to hear your thoughts. Where do you think it's going? Let me know down in the comments. And if you're someone who's been thinking about buying, selling, or investing in my marketplace of Surrey, Langley, and the rest of the Fraser Valley, or you just want to have a conversation about real estate, you can book a no pressure, no obligation call down below at a time that works best for you. Thanks so much for watching. Make sure you check out another video on my channel before you get out of here, and we'll see you in the next video.